Over the past year, PepsiCo is down by 14.55%, and so with the upcoming earnings on the 4th of February, should you add this dividend king to your portfolio? Well, the thing you have to understand is that Pepsi is a very steadily but slowly growing company. You can see that over the past 10 years, they are up by only 46.61%, so they have underperformed the market. But this is traded for their low volatility, which many investors are willing to pay for. So if we jump to our stock valuation spreadsheet, we can have a look at the beta of Pepsi sitting at only 0.54. And this essentially means that if the S&P 500 jumps up by 1%, PepsiCo will jump up by only 0.5%. If the S&P 500 drops by 2%, PepsiCo will drop by only 1%. So PepsiCo has very low volatility, but on top of that they also have a very high dividend yield of 3.80%, the highest yield they have had over the past 10 years. So if you invest into the company right now, in 10 years your yield on cost could be well above 10%. Now you can see that the trailing free cash flow payout ratio is sitting in the red, but I don't really mind being it so high as PepsiCo doesn't need to push a lot of their free cash flow into innovation. Now jumping straight to the 9-pillar analysis, we can see that the company gets a rating of 6 out of 9. Their revenue has been growing at a slow rate of 6.59% yearly, their free cash flow has been increasing at a rate of 12.23% yearly, and their net income has been increasing at a rate of 5.79% yearly. Now one thing that worries me about PepsiCo slightly is their high long-term liabilities over the 5-year free cash flow negative dividends ratio sitting at 17.90, and this essentially means that it would take Pepsi about 90 years to pay off all their long-term liabilities while paying out their current dividend. Now why this doesn't worry me enough to not buy the company is that if they were to cut their dividend, they could pay off all their long-term liabilities in about 10 years with the free cash flow they generate. Now the one thing many investors love about the company is their consecutive dividend growth sitting at 6.69%, and they have been raising it consecutively for more than 50 years, which makes them a dividend king. I also love the fact that they have decreasing shares outstanding at a rate of 0.40% yearly, which raises their intrinsic value essentially, and their 5-year profit margin is sitting just at the tipping point at 10.17%. Now if we have a look at their 5-year PE ratio, we can see that it is sitting at almost 27, but if we zoom into pillar 1, we can see that currently it is sitting at 21.01, so PepsiCo would be considered undervalued compared to the price to earnings they were trading in the past, and this is the same case with the price to free cash flow. So now that we have gone through the 9-pillar analysis for PepsiCo, let's calculate their intrinsic value. So first, jumping to the Graham's formula revised, we will get an intrinsic value of $106.51 after plugging in the 5-year earnings growth estimate at 5.45% yearly. Now moving to the second valuation model, the discounted cash flow model, I will calculate a growth rate into the future of 6.3% and get an intrinsic value of $192.22. For the third valuation model, we will compare PepsiCo to 3 of its competitors and get an intrinsic value of $213.64. And for the final valuation model, we will take the dividend growth of PepsiCo, project the dividend growth of 4% into the future and get an intrinsic value of $234.18. And finally, arriving to the ultimate valuation, we will average out the 4 valuation models and get an ultimate intrinsic value of $186.64, which is 30.1% higher than the current trading price. Now I do believe that right now, before Pepsi's earnings, it is the best time to add the company to your portfolio and hold it for the next 10 years plus, as it is a great company. And with that, let me know down in the comments if you are buying, selling or holding Pepsi, and also make sure to like and subscribe as it really helps me out.